You might notice that we started talking about investing now. The reason we do that right now is that we understood that we want to take advantage of compound interest. We now know that just saving is not going to get us anywhere. We need to leverage the impact of compound interest, and the way to do that is by investing. But first, we need to define what investing means. So investing is when your money makes money for you or instead of you. Think about your primary source of income right now. It's most probably a job, right? So you spend your time and expertise and you get some money in return for that. And it's usually quite linear to this amount of time that you spend. So if you have one job right now and you get another job, you probably get paid more. But the concept of investing is when you take yourself out of the equation, you put your money somewhere, and just for the sake of having that money there, your money is gonna make more money for you. In order to better understand that, let's go back to our example of putting away 1,000 kroners per month in two scenarios, just saving and investing with compound interest. In just savings, we are going to have 480,000 kroners, and in compound interest and investing, we have 3.5 million kroners. Now my question is, how much of that 3.5 million kroners do you think was put down by us? And how much of it was created because of compound interest and because of investments? Some of you may have noticed 86% of your wealth in this scenario is the interest that you gain, is the money that your money made for you. So out of that 3.5 million kroners, you have put in only 480,000 kroners. And the rest of it, 3 million kroners of it, is the additional interest that you acquire. So that's exactly what we call investing. It's your money making money for you. And it turns out that your money is actually much better at making money than you are, because you have a very limited amount of time that you can put into a work, right? So if for whatever reason you cannot work half of the time, your pay is probably going to get cut into half. If you increase your job by like 2 times the amount of time that you spend on it, you might get 2 times more. But there is so much that you can do. Like you can have 2 jobs at most, right? And that's pretty much it. You cannot go higher than that. But there is virtually no cap in how much money your money can make for you, depending on what sort of return you will get out of an investment, right? So that is the definition of investment. Now the question becomes, okay, I understand this. What things can I actually invest in? And there are a multitude of those. So the one that most people are quite familiar with is properties, right? So everyone kind of knows that if you buy a property, most probably in the future, the value of it will go up. So that means that you have made some money. You put some money somewhere, and just for the sake of having that money there, that amount is going to increase and you're going to have some profit out of it. So that's one sort of investment. Stock market is another sort of investment. What is stock market? Stock market is essentially you going and buying a small piece of different companies, right? So you can right now go and say, okay, I want to buy a very, very small piece of Apple. I want to buy a small piece of Microsoft, whatever, like what other company you are interested in. So the stock market is essentially a collection of companies that are publicly traded, meaning that they sell part of their shares to individuals over the world, and you can buy a small piece of a business, a small piece of a company. Other investment types, you can invest in commodities, things like gold and silver and other rare materials and stuff like that. That is some sort of an investment. You can invest in small businesses. So you can think about Like if your buddy, if you're one of your family members wants to start a business, they might ask you to, would you invest in that? Then you put down some money in order to get them started. And if they actually make it, they are going to give you some money back. So that is another sort of investment. You have other investment types, like you have bonds, and you have like a lot more different things that you can potentially invest in. Bonds in particular here is one of the most like safest ways of investing. So this is usually something that is backed by a government. So you essentially buy a piece of what the government owes, and they actually guarantee a certain level of return on that. That return is quite low, but the risk of it is actually very, very low as well. And a lot more that you can invest in, right? So now the question is, where do we want to go? Like, which one do we want to focus on here? Our focus in this course is to make this as easy as possible for you. You don't need to understand every single of those markets. You don't need to understand the difference between this investing and that investing. There are very few things that you need to understand, which we are going to run through. We are going to focus on one of those investment types, and that is specifically stock market investing. As we said, stock market investing is essentially you buying a small piece of a business, of a company. You might ask, then how do I choose which company do I buy a piece of, right? Before answering that question, I want to show you something. I want you to look at the history of stock markets, specifically in this scenario, the US stock market. And the picture that you have on the left here is the top 10 companies in the US stock market in different time periods. So top left, 1990, what were the top 10? 2000, what were the top 10? 2010 and 2024. And what I want you to really pay attention to is how much of a difference you see in those companies being in the top 10. How many of the top 10 companies that were there in 1990 are still there in 2024? Just by looking at this image, you see that number is not that high. So in 1990, we had IBM, ExxonMobil, General Electric, Philip Morris, Shell, and you see none of those companies in the top 10 in 2024. None. Even comparing 2010 with 2024, you still have ExxonMobil, you have General Electric, you have Chevron, you have IBM, you have Procter & Gamble. None of them are in the top 10 in 2024 in like a 14-year timeline. So the reason I'm bringing this up is investing in the stock market is risky, particularly because choosing an investment is quite difficult. Because it's not an easy thing for you to decide which of these companies are actually worth buying. And keep in mind, as you can see, those companies come and go, and they have different levels of success in different time frames. So not only you need to make a really, really good and difficult decision on what to buy right now, you also need to make a second really good decision on when to sell what you bought from that company. Because if you had IBM in 1990, you would have been fine. But if you did not sell your IBM in the next 10 years, you might have lost money, or you might have not gained as much money as you could have, right? So buying a single company's stock becomes very risky and a very difficult thing to do. Think about this. There are hundreds and hundreds of fund managers and people working in Wall Street and other financial markets trying to do exactly that, trying to pick the best stocks possible at this moment and then try to decide when to sell, which is optimal. So really think about this. How much time do you actually need to spend on having a good strategy on choosing a stock for a specific company? that number is super high. You need to spend a lot of time trying to understand a lot of technical aspects of how you choose a single stock. And there are millions of other people, not only regular people like you and I, but professionals that are paid specifically for this. They have companies of thousands of people working on this. They have all the latest technology with access to all the latest and most up-to-date news, and even maybe some like internal connections to other places. You are competing with that market. You are competing with everyone else who is trying to pick the best stock. And from a personal experience and from learning from a lot of other greats in the finances, I'm gonna tell you that that is not a good strategy. For regular investors like you and I, who have regular jobs and don't want to spend pretty much all of their life or all of their free time in learning how to choose a stock, choosing a single company to buy is not a good strategy. Then you might ask, then what is a good strategy? And this is the part that I want you all to focus on a lot. So the idea for us is to decrease the risk of buying a single company. When you buy a single company, you are essentially betting that that company is going to do better in the future than they are doing right now. And as you have seen from the previous graph, a lot of the companies don't. They don't necessarily do better, or they don't do better than other companies. So that bet becomes very tricky. The solution to that is for you to look at the whole market, and instead of buying one small piece of one company, you would want to buy everything in a market, right? And this is now a very different value proposition. Now, instead of betting and saying, I'm gonna bet that Apple is definitely gonna do better in 20 years time, which you don't know if they're even gonna be around, now you are betting on, I think that the financial markets in the world, the economy of the world is gonna be better 10 years down the line, 20 years down the line, right? And that is a much easier bet to make for people like you and I who don't have the resources or the time to kind of analyze every single aspect of every single market. That is not possible. So the idea is that, okay, instead of trying to pick and choose, let's buy everything that exists in that market. And historically, we can see that this strategy works. So on the right side here, you have one of these, what we call indexes, which means a good chunk of a whole market. So in this particular example, we have S&P 500, which is the 500 top biggest companies in the US market, right? And the graph tells you how much, if you had bought a small piece of S&P 500 throughout time, how much would it have increased in terms of value? And historically, if you look at this graph, you obviously see some dips and some rises at different times and points in time, but generally this whole graph is going up. So if you start from 1984 to today, it's going up. It has its dips and ups and downs, but generally it's going up. So if you look at the trend line here, so if you create a line here, you see that it's always going up. And that's what I was talking about. You are betting on the economy of the world or the economy of a certain market to be better in 10 years time, in 20 years time. And historically, we have seen that is the case. Like the economy has always gotten better over a long period of time. To put that into numbers terms, this graph at the bottom, right? So in the last year, the return of S&P 500, this is from 2024, so last year would be 2023, 22% return. Last 5 years, on average per year, it was a 15% return. In the last 10 years, on average, it was a 13% return. And in the last 20 years, on average, it was a 10.5% return in S&P 500. So that immediately shows you that historically in the last 20 years, even longer than that, in the last 70 to 80 years, the markets have constantly been going up. So this is the strategy that we talk about. Instead of trying to pick a single stock, which you have no idea whether they're going to be around in 5 years time or 10 years time, you're going to buy the whole market. You're going to buy what we call an index fund, which is exactly this. A big portion of a market, you're going to buy everything in that. And your hope is the economy is going to go better down the line. If you remember from our previous calculations in the compound interest part, we talked about an 8% return on an annual basis, right? So we did all of those calculations based on 8%. And that 8% came from what we just showed you. So S&P 500 in the last 20 years has returned 10.5% per year on average. And if you adjust for inflation for an average of 2.5% per year, then you have a number around 8%. This is not an exact number. This is just a rough number for doing your calculations and understanding. You can do it with 7, 7.5, 8.5. You can like play around with it. But that is roughly a good number to start with and do your calculations with. To better understand what is the effect of the time horizon that we are talking about, let's look at the historical data out of S&P 500. So in the S&P 500, in the graph that I showed you a couple of slides before, any 1 year periods that you pick, any 1 year period, in 73% of the time, you have made a profit in the market. Your money would have increased. For any 3 year period that you pick in that 40 year period, 84% of the times you would have made money. 5 year periods, it's 88% of the time. And 10 year periods, it's 94% of the times you would have made money in the stock market if you bought the whole market. And if you increase that time horizon to 20 years, 100% of the 20 year periods in the S&P 500 would have returned positive gains for you. So if you have a time horizon of 20 years, then essentially historically you would have never lost money. Keep in mind that historical data does not guarantee anything about the future, but it's the best indication that we have, it's the best strategy that we have if we have a long-term horizon. And now think about what we talked about in compound interest, which was mostly about time being the biggest contributor to building wealth. So compound interest wants us to increase our time horizon because the more time we have, the more money we are going to build with that exponential graph. And markets, real data from the markets are also showing us the longer that we make our time horizon, the less risk we are going to have. The higher opportunity of making money we are going to have. So this is essentially becomes a match made in heaven, right? Time horizon is good for compound interest. Time horizon has historically been good for making money in the markets as well. So if you have a long enough time horizon, then you have very, very little risk because markets most probably will go up almost always. At least historically, they have always done that. And from a compound interest perspective, you are gaining an average of 8% per year. So that is also building the huge amount of wealth that you have seen in previous calculations.